Welcome to our PPP Forgiveness webinar, being co-hosted at Midwest Bank Center and our great partners at Clifton Larson Allen. We want to thank them for joining us on this and many other webinars we've done during this PPP process. This morning, we're happy to be hosting the webinar for the Council of Construction Employees. I give credit to Ray Hefner of the Plumbing Industry Council. He reached out to me earlier, I guess it was late last month actually, asking if Midwest Bank Center, along with our PPP experts, CLA, could spend an hour or so with this group going over the forgiveness process of the Payroll Protection Program. I guess it's safe to say it's been an interesting 5 to 6 months since we did our first PPP loan back in April. The stimulus package was put into place and we started taking PPP applications, and boy, did they ever roll in. Since we started the process, Midwest Bank Center has done over 1,400 PPP loans. That totals over $210 million that we've done during this period of time. And we're very happy to say that over 80% of our PPP loans have been under $150,000, and that it's impacted close to 20,000 employees by making those PPP loans and keeping people employed, which I think is very important, not only for this group, but for all of the small businesses and middle market clients that we have and across the St. Louis area. So once again, extremely our group on here, but now we get into the point of forgiveness. So we got through the application process, which presented its degree of challenges. Now we're looking at the forgiveness process, which is a whole new set of challenges as we start taking applications for this. So before I turn it over to our good friends at CLA, just a couple of housekeeping matters. If you're not speaking, if you don't mind to have your phones on mute, it does cut down on the static and everything. In addition, we do have a chat feature at the bottom of your screen. So if you have any questions that come up during the presentation, feel free to go ahead and type those in, because we are going to leave time afterwards to answer those, as well as any verbal questions that you'd like to ask the group. So once again, I thank everybody. I especially want to thank the group from CLA with us here today, Tim O'Shaughnessy, Jen Rowan, Jack Rybicki, and Rick Kruger, who I will now turn it over to. So Tim, I'll give the floor to you.
Thanks, Danny, and good morning to everyone joining, and thanks for taking the time this morning to join us on this web call. As Danny mentioned, my name is Tim O'Shaughnessy, and I'm the managing principal of the St. Louis office here for CLA. And I want to thank Midwest Bank Center. I want to thank Aaron. I want to thank Nicole, Danny once again for letting us participate in this webinar. For those not familiar, CLA, we are a professional services firm here located in St. Louis as well as around the country, about 120 locations. And we exist for really one reason, and that is create opportunities for our people, our communities, and our clients. And we do this through an industry focus, wealth advisory, outsourcing, audit, tax, and consulting services. One of our 4 strategic visions, which I think really plays into what we're talking about here with the PPP loan forgiveness, is really we consider ourselves the premier resource for privately held businesses and their owners. And what we mean by that is we strive to understand our clients' businesses. We understand what keeps them up at night. And I think that is very evident in the way our firm with Jen and Jack and Rick, the way they leaned in on this PPP and realized this was such a big issue for our client base. We need to understand it and help them navigate through not only applying, but also the forgiveness portion of that. So with that, once again, thanks for having us. Thanks for everyone for joining. I will turn it over to, I believe, Jen to kick this off for the group. Thanks, everyone.
Yeah. Thank you, Tim. And I'd like to echo your gratitude to our friends at Midwest Bank and just to all of you for joining today. This has been such a learning process over the last 6 months, and really we have spent a lot of time understanding it, and of course it always makes the most amount of sense, and the way we learn the most is within its specific application to you guys. So please, I'd like to encourage all of you as we present today on the topic of forgiveness, some of the mechanics of it, some of the considerations around timing, some of the tax issues. please do share your questions. I'll be in the chat box. I just sent a note to everyone, as will Tim, kind of answering as they go along. But I'll be able to interject with Rick and Jack's formal presentation with your questions, just to make sure that we're getting them answered in a dynamic way. And as Danny said at the end, we'll also take some time just for solid Q&A. The other little bonus item that we have is on August 8th, as you may have read, the president issued an executive order deferring employee payroll taxes in addition to the already in place employer deferral of payroll taxes. A new 941 has been issued. So we've done some deep dive. We don't have specific slides on that, but just while we have this group together, just if it adds some value and you have questions about either the employee deferral, the employer deferral, or kind of how the mechanics of that look on the 941 with some of your other, CARES Act credits, please feel free to reach out to us either in the chat with those or after the fact via email. So just wanted to add that in. We're excited for the presentation. It's going to start today with Rick, just kind of walking through some of the mechanics. So Rick, I'll hand it over to you, and enjoy and looking forward to the interaction, everyone.
Well, thanks, Jen, and thanks everybody here. Getting just a little bit of feedback here. So as I flip forward, there are kind of two main parts of the presentation that we're going to spend some time on here. The first part is talking through the mechanics of how do you calculate how much of the PPP loan is actually going to be forgiven. The second part that we have in the presentation is more process focused. What's the process of applying for forgiveness? What does the review look like? And what are some timing considerations to keep in mind as you decide when is the right time for your organization to actually turn in your forgiveness application and begin that journey? But with the size group that we have, I think I'm really excited about this. I think this will be great for an interactive session here. We have a lot of content in the slides. We did that intentionally so that you guys can walk away and have something to look at. Don't want to read word for word off the slides, but if we're going too fast or if we want to bounce to something that's a little bit more relevant to anybody on the line here, happy to do that and to be pretty flexible with how we present this. That said, the first part here is the forgiveness calculation. This colorful slide here that we're going to start off with shows the different mechanical features of the calculation. And we're going to dive a little bit deeper into each one of these. But if you take a look at the forgiveness application, basically you end up calculating three amounts, and that's what the three columns on this slide are for. And you take the lowest of those three amounts, and that's how you determine what's actually going to be forgiven under PPP. So the first column takes your allowable costs. So are you spending things based on the program description for PPP? And then has two items that get backed off of that. One would be wage reductions in excess of 25%, and the other would be reductions in FTEs. The second middle column here is the amount of the PPP loan. This one is a little bit more self-explanatory. You can't have more forgiveness than your loan itself. So that's one cap to have in mind here. The third column on the right side is one more to keep in mind. And this basically emphasizes that PPP, the Paycheck Protection Program, is really designed to help with payroll costs for the majority of what you're spending your loan amount on. So what it says, and I like to think of it maybe as the opposite of what's on here and what's in the application, non-payroll costs are capped at 40% of the amount of forgiveness. So in other words, to the extent you want forgiveness, most of that money needs to be spent, at least 60% needs to be spent on forgiveness. And then at the very bottom in yellow here, no matter how good you do with the top three columns, if you got an EIDL, the Emergency Injury Disaster Loan, through the SBA, which was a different program, if you got that and you got the up to $10,000 advance, which you do not need to repay, that does get backed out of PPP. It's basically an either or. All right, so diving into some of this a little bit deeper, on that left column, we said that the first item to consider is what did you spend the money on? So the first question in everybody's mind is, okay, what's just eligible period? And the SBA breaks this down really into two broad categories: payroll costs and non-payroll costs. You add the two of these together, that's what goes onto lines 1 through 4 in your forgiveness application. And then you start making adjustments from there. And we've got slides talking through each of these in a little bit more detail. So I'm going to flip ahead. But definitely we can go back to dive into this in more detail so everybody understands what to actually put on the application. As far as time period, the SBA and the law itself refers to a covered period for us to keep in mind here. And many borrowers have two options for what time period to use when you're tracking expenses allowable for forgiveness. Every loan for PPP has a 24-week covered period option available to them. You can accumulate costs over a 24-week period and then report those. Some loans, if you had a loan that was originated before June 5th, you also have an option to choose a shorter time period for 8 weeks. Why would you ever want to choose a shorter time period if you have fewer expenses in an 8-week? There might be some considerations around FTEs, that perhaps you had enough money to keep people employed for 8 weeks, not enough money to keep them employed for a full 24. So again, we'll talk through some of those timing considerations too, but that might be one reason why a borrower would prefer an 8-week over 24. One additional option that the SBA gave us is that borrowers can file a loan forgiveness application before the end of your covered period. It's the third hyphen in the 24-week covered period on the slide here, where they said, to the extent you've spent the money you're going to put on your application, you can turn in that application at any point from then through the loan maturity date. But we're missing a little bit of guidance if you want to be on the front end of this. So we'll talk through that a bit, but they've given us very, very little information on the details of how would you calculate FTEs if I'm applying for a 24-week period, but I'm doing that application at week 12, let's say. So how does the covered period work? We put a little example here to hopefully make this a little bit more tangible for everybody. So the covered period is really your time period to track costs that are eligible for forgiveness. What do you get to put on your application itself? So in this example here, it shows the two different options that we have available to us, whether we're choosing age or 24. You take your loan, let's say you turn in your application on April 1st, your loan was funded on April 15th, and that officially begins your covered period. However, if you have a biweekly or weekly pay cycle, you can shift for payroll purposes that covered period to better align with your weekly or biweekly pay cycles, and they call that the alternative payroll covered period. That doesn't necessarily change your covered period, so for non-payroll, you're still stuck with your April 15th, and for an 8-week period, which would end on June 9th. But for payroll purposes, you do have an option of shifting that, so it's a little bit cleaner for reporting to align with your actual pay weeks. So what is included in payroll costs for that overall category? There's really 4 components of that here. You've got salaries, wages, and for the most part, we're talking gross wages. When we talk about this, that the only big exception to that that's outlined in the law is the Families First Coronavirus Response Act, the FFCRA, allows a couple of types of paid leave, and you get a credit for that as an employer. If somebody takes that paid leave under FFCRA, and you can get that money back. Those gross wages are not allowable. Basically, everything else, though, is to the extent you're not double dipping with other government programs and reporting the same wages twice. Group health care benefits is another category. Retirement benefits is another category. And the fourth category here, which tends to be a small one, is the employer portion of state and local payroll tax. What is that in practice? It's probably just your state unemployment tax to the extent that you pay SUTA. There's usually not that much else that would fall in the employer portion of state and local payroll taxes. Since we're not talking income tax, we're just talking payroll tax. A lot of information on here. Again, we said everybody will get these slides, so some of this is meant a little bit more as a takeaway. I'm just going to point out a couple of things in the second and third bullets on this slide here. And really that's, if you think about the time periods we mentioned before and the types of costs, the next question when you get into the details is going to be, okay, what exactly is my cutoff? What exactly can I include in these time periods here? There's actually a fair amount of flexibility that of all the rules that have come out of the SBA, these have been some of my favorites because it's been beneficial to borrowers and given us some flexibility. So the general rule when it comes to timing with a covered period is anything that is paid during your covered period, or if you're choosing the alternative payroll covered period to align with payrolls, anything that's paid during those periods is allowable on your application. And anything that's incurred during those periods and for payroll paid by the next regular paycheck date is includable in your application. And they've actually been pretty explicit about this in FAQs where they've said, even if you incurred the wages prior to the covered period, prior to your loan, if you paid them during your covered period, that is allowable on your application. So what that ends up meaning is for an 8-week covered period, more likely you'll end up having maybe closer to 9 or 10 weeks worth of payroll in that 8-week period. For a 24-week covered period, you might end up with 25, 26 payrolls in that, or weeks worth of payroll in that time period. So definitely good. On the back end though, anything paid during the covered period is allowable. Anything that is incurred, you'd need to do a little proration for that. You'd only get to take the portion that was incurred. So if you had 1 week fall in your covered period, 1 week fall outside, and then it was paid by the next regular payroll date, you'd get 1 week worth of that. So that's how you can end up with a little bit of an odd number, is that proration on the back end. There are limitations, though, on how much compensation you can count. This applies to some of the higher earners within an organization and to owners of an organization. The limits are different if you choose an 8-week covered period versus a 24, and they're different if we're talking employees versus owners. So that's where you have the 2 boxes, depending on which covered period option you select, and the 2 bullets because the limits are different, employee versus owner. So just to talk through this a bit, for an 8-week covered period, employees are limited to $15,385 worth of compensation that you could report, cash compensation that you could report on your forgiveness application. You can still pay them more than that, but anything in excess of that doesn't get counted towards forgiveness. Owners are capped at that $15,000, and they have an additional restriction that you can't have more forgiveness than what they would have made during an equivalent time period during 2019. So basically 8 weeks worth of their W-2 wages from last year, if they're a W-2 employee as an owner, or if they're not a W-2 employee, if they get a Schedule C or a K-1, it would be 8 weeks worth of their net profit with a couple of slight adjustments, but give or take 8 weeks worth of their net profit from 2019. For the 24-week time period, the employee limit is pretty generous here. They just increased it based on the number of weeks. So they took what was 8 weeks worth of 100 grand and made it 24 weeks worth of 100 grand. So employees are limited at 46,154. For owners, though, they set that threshold lower. You don't get quite as generous of treatment as an owner. You're capped at $20,833, or if it's lower, 2.5 months worth of the 2019 income or W-2 for that owner. And not to stop there, the SBA made some more restrictions too on what you can report for health and retirement. Fortunately for employees, really not much of a limitation here. SBA has been pretty good. They said this is a non-cash benefit. It's not subject to the limits we talked about on the last slide. The only real limitation here is you only get to count the employer portion of your cost when it comes to health and retirement. You can't take the full amount that you're paying into health. You'd have to just take the employer portion of that cost. There are some restrictions though for owners. So And again, it's a little bit different if you're self-employed or a general partner versus owner employees. So that would be your S Corp or C Corps. For self-employed and general partners, unfortunately, they're not eligible for forgiveness on health and retirement. There's some rationale they gave, but the short answer is it's unfortunate, but it's not eligible. For owner employees, again, that's capped based on either 8 weeks worth or 2.5 months worth of the 2019 contribution amount for retirement. For health, S Corps are excluded altogether from health because in theory, that should be part of the W-2 wages that you're paying that individual. All right, a couple other FAQs, things we've learned along the journey here. We get the question a lot, what about bonuses, hazard pay? If I do something like that, some organizations had to actually increase wages as a result of COVID for some of the things that employees were dealing with or to retain employees. The SBA has said those are generally eligible for forgiveness. They haven't really given us many restrictions, if any restrictions on that. I mentioned before, gross wages are more or less what you would use for your forgiveness reporting, which is great. Really, the only exception to that would be the FFCRA credit eligible wages. For healthcare benefits, it does include payments on self-insured plans. There's still maybe a little bit of gray on this, on what exact types of plans are included in healthcare benefits, but the easiest division line in my mind is things that are more income continuation exclude. So your disability payments, life insurance, stuff like that. Things that are more clearly in the healthcare category likely would be included, or at least hopefully would be included. It does appear, though, that prepayments of health and retirement would be ineligible. They've used a slightly different language. When they've stated this, what they've said is acceleration of healthcare retirement is ineligible. If I tried to interpret what the SBA means by that, I think what they mean is you can't prepay retirement for the rest of 2020 and count that for forgiveness during a short time period. They've been fairly generous with some of the flexibility. I just don't think they mean to be kind of unlimited flexibility with that. And the one other thing that they've told, I mentioned before, some of the limits on owner employees. This actually was a pretty good one. Originally, they left this really open, and it seemed like it would apply to anybody who has any ownership in the company and works for the company. They clarified later to say those limits only apply to a greater than 5% owner of a business. So that actually is a nice one, that if you have a small ownership stake, you're just treated like a normal employee for the caps and limitations. All right, changing gears to the non-payroll costs. There's a few categories here that we get to include: interest on mortgage obligations, rent, utilities, and there's a green one towards the bottom that I'm going to touch on at the very end here. But for those first three categories, that's what's laid out in the law, and that's the language that they use in the application. A couple of things to point out with these. One thing that's important is this wouldn't count anything that's new. The contracts need to have been in place before February 15th in order to count. So if you leased a brand new facility on or after February 15th, or you entered into a brand new mortgage obligation on or after that date, unfortunately, that wouldn't count for PPP forgiveness. The agreement needs to have been in place before that date. When it comes to these items, though, they've actually been fairly generous. With mortgage obligations, they've defined this as included what you traditionally think of as a mortgage. So, mortgage obligation on a building where there actually is a signed mortgage agreement within the loan documents. They also clarified in an FAQ, though, that other obligations, interest on other obligations that are secured by personal property are includable in that as well, which is great for borrowers, that it suddenly includes a lot of other debt that might not have been included if you just narrowly define mortgage to real property. And actually, we have a slide coming up, so I'll skip further details on that. But the next category on here, rent, again, they've been pretty open about this. They haven't set many restrictions, but one of the restrictions they have set is on related party rent. So if you have a building, let's say, in a separate LLC and you're paying rent to that, but it all rolls up to the same ownership, so a pretty common structure, you're limited on what you can take for rent in the PPP forgiveness application to basically the amount of interest that the lessor is paying on that property there. Which makes sense that if it were all owned by the same entity, you'd be restricted to the interest on it. If you put it in a separate entity, it wouldn't make sense necessarily that you could get the principal portion of any debt on that. You could take profit on it. So that's why they added the restriction on that. And utilities is the last category. And the SBA does give a bunch of different subcategories for utility. When it comes to some of the details here, I'll point out a couple of things, but again, some of this is meant as takeaway. We'd have similar flexibility from a non-payroll side. Things that were paid, non-payroll costs that were paid during your covered period are eligible for forgiveness. Non-payroll costs that were incurred and paid by the next regular billing date are includable. At least the prorated portion of it is includable. So the SBA actually gives an example for an 8-week covered period with utilities, where you pay utilities the month following when you incur it, where based on that, they show that you could take almost 3 months worth of utilities for an 8-week covered period because you paid 2 and then you incur another month during your covered period that was paid shortly after that. Well, actually, the last bullet on here, though, is important. The one cap on this that we mentioned at the beginning is that 40%, that no matter how much you spend on some of these items, though, there is an overall cap that no more than 40% of your forgiveness amount can be spent on non-payroll costs. So at some point, you cap out what you can spend here if you're not spending enough on payroll. As far as prepayments, it's really clear for interest on mortgage obligations because that's actually written into the CARES Act, so the law itself, that you can't prepay interest on mortgages and count that to forgiveness. It's a little bit less clear for rent and utilities. Theme with a lot of this with PPP in general is this evolves over time. This tends to be a marathon, not a sprint, in terms of the guidance that we're getting. So there certainly are still some areas that are unclear and might allow borrowers flexibility. The more you play towards the center of the fairway, the more you take the things that are just kind of really obviously okay, I'd say the safer you are as you work through your forgiveness application and actually turn something in. Some of the FAQs and information that we've gotten over time on non-payroll costs, on interest. And like I said before, it does include loans secured by personal property. It definitely does not include unsecured loans. What's a little bit less clear is if you have an asset-backed lending that's secured by accounts receivable or inventory or things that don't really fall in the real or personal property categories that they gave us. There's not really a clear answer whether or not that interest is includable. Getting a little bit of feedback from somebody. Utilities is another one that they've clarified, sort of. There's a category within utilities that the SBA gave us for transportation. They did tell us what was meant by transportation, which is, it really just relates to transportation utility fees, which might be assessed by state or local government. So that's a pretty narrow definition there, wouldn't apply to many municipalities across the country. There are still some advisors that are arguing that certain things are includable versus excludable. Some are much clearer cut than others. Again, I think if it were me filling it out, there's certainly flexibility with this, but again, the more you take really, really obviously includable items to get to your forgiveness amount, I think the safer you are. The fear in my mind with a lot of this stuff is SBA is still clarifying things, and if they clarify something that excludes something that you thought you could include, that just puts you in a bad position later on. So the more you can find costs that are just truly, easily, obviously eligible, I think the better off you are.
Rick, before we move on, as far as utilities are concerned, could you address cell phones? I think that's always a big question, especially when you've got like a fleet of people out. Maybe that's one that's probably on everybody's mind.
Yeah, great question, Jen. And to anybody who put it in the chat, great question. So telephone is a category that's included for utilities within the SBA's definition. So they do state that telephone is includable. They don't specifically say cell phones or mobile phones or something like that, but it would certainly seem to be in play in my mind. And I would think of it as a reasonable cost, especially in the environment that we're in right now. The thing to keep in mind, though, when it comes to that would be how you set up the arrangement at the company. That this needs to be cost that the employer is paying. So the employer needs to have a service agreement in place with the provider for that, really to meet the overall definition for utility. So you need to have had that in place prior to February 15th. So if you're just reimbursing employees, I think that would be less likely to be includable. The only exception might be if you just pay a taxable allowance to them. So if you give them a set amount of money to spend as they please and tell them that it could go to cell phones, that might be includable. But if you're doing a reimbursement plan where it's not taxable wages to the employee, I would say that likely that's not includable. If you are paying it directly from the company and providing cell phones to employees, I would sure hope that the SBA would allow that. It would seem to fit the definition.
Yeah, that makes a lot of sense. Thanks a lot.
I mentioned before, related party rent, so eligible cost is limited to the interest at the related party, proportionate to the space used. That last part was something I didn't mention before, but something to consider. If you're only renting part of the building, you wouldn't get the full interest cost. You would just get the portion related to what you're renting or the borrower's renting. They do also have some guidance for sublease arrangements, tenants, co-tenants. The basic theme, and this kind of makes sense for this, is that forgiveness would be limited to what your net cost is. So, if you're paying rent, but then subleasing a portion of it, you wouldn't get to take the full amount you're paying for rent, just the true net cost to the borrower. And with that, Jack, I think I'll turn it over to you if that works.
Great, thanks, Rick, and great job explaining kind of the pools of costs that are includable here. Not too many questions coming in the chat related to those, so I think this goes to the thoroughness of the presentation, and we have gotten some good answers on that over the last couple months now. So I think there's less and less questions that are still outstanding there. So, with that, Rick's really covered that box number 1 on this chart right now. And so I'm going to spend some time now going into boxes number 2, the blue box, and then number 3, the green box, that talk about the wage reduction test and the FTE test. So these would be applicable to you if you are filing the long form, forgiveness application. So this would say that you didn't meet one of the 3 criteria that are out there to be able to do the EZ form, and we will go over those. But you are going to have to do the long form and consider whether or not you have any wage reductions or FTE reductions as part of your application. So, Rick, if you can go to the next slide. The one thing I want to stress to everybody is before you start calculating these amounts, the first thing you should do in each section, both the wage test and the FTE test, is look at whether or not you qualify for the safe harbors. The safe harbors effectively exempt you potentially from having to apply that test, and will obviously save you quite a bit of time in the process if you meet those safe harbors. So for the wage test, you do not have to do that test if you can support that there was no wage reduction if there was a wage reduction between February 15th and April 26th, but that you've eliminated that reduction by the application date or December 31st, whichever comes first. And so, this was a safe harbor that was in the original plan that was really an incentive for companies that had done something to their employee wages, so reduce the salary amount or reduce the hourly wage amount, before they got the loan. But since they received the PPP proceeds, they restored those amounts back to pre-COVID levels. And so if you fall into that, you don't have to apply the wage reduction test because you would have met that safe harbor. If you don't fall into that category, though, and you did have to actually have wage reductions that you restored in order to fall into that category, then you do have to look at whether or not you had a wage reduction in excess of 25% when you're comparing the average wages during the period, your covered period, to a pre-COVID period, generally that first quarter of 2020. And so the way you apply the test is fairly simple. The good thing is you only have to apply it for employees that made less than $100,000 in 2019. So what that means is that if you had somebody that was highly comped in 2019, let's say they made $200,000, and you decided that you were going to reduce their salary to $125,000, for instance, even though that would be more than a 25% reduction in that individual's wages, because that person was over 100,000 in compensation, they are excluded from this testing. And that would go true even if somebody started at, let's say, 125,000 and you reduce them down to 80,000, that person also would be excluded from the testing that you would have to do, because you would look at the 2019 wage rates in order to make that determination. So in terms of the wage reduction test, one thing that we did get clarification on, thank you, Rick, is that you use the salary or hourly wage. So you don't actually look at what somebody got paid during the period, because that could vary based on a number of factors that are out there. For salaried people, they may cut back their work schedule, and as a result of that have gone on an alternative work arrangement and just getting paid a fraction of what they got paid before. From an hourly perspective, you may have had somebody that used to work 40 hours a week, but because of demands on their time are now only working 20 hours a week. So when you look at their paycheck, their comp may have gone down by more than 25%. But when you're measuring this wage reduction, you look at the rate of pay, not the actual pay. And so as long as you used to pay somebody $20 a week or $20 an hour, and you're still paying them at least $15 an hour or more, you would not have a wage reduction related to that individual. Same thing goes with salaries, that if they were under 100,000, but let's say they had a compensation of $50,000 before, as long as you were paying them more than $37,500 now from a salary perspective, regardless of their alternative work arrangement, if they have one, that would still be acceptable, and you would not have a wage reduction. So, really good guidance that did come out on that. Now, the one thing that we did get guidance on related to the 24-week period is that if you fall into using the 24-week covered period, if you have a wage reduction, you actually have to measure that wage reduction for the full 24-week period. And this is regardless of whether or not you're using the full 24-week period as your reporting period. So Rick alluded to earlier that it is allowable that if you're in that 24-week covered period, to file for forgiveness earlier by, say, only using 12 or 13 weeks worth of accumulated costs. However, if you did see that during that 13-week period you had a wage reduction, you would actually have to extrapolate that for the full 24 weeks. So your wage reduction related to those employees that have those would be greater than the amount that you paid to them, greater from a period perspective than the amount you paid to them. So what that means is just a planning opportunity, right? That you have to know what wage reductions you're going to take And then as a result of that, maybe you include an additional 1 week of payroll so that wage reduction doesn't take you down below your loan amount on a net basis when you're applying for forgiveness. So Rick, if we can go on to the next slide and talk about the FTE test. Here, the safe harbors are particularly important. And there's a couple of them out there that are really important to look at. The first one is obviously if you didn't reduce any number of employees or the average paid hours from January 1st through the end of your covered period, then you don't have to worry about the FTE reduction. That one's fairly intuitive, and that's the second criteria on the EZ application. The one that's not quite as clear, but likely will impact a lot of businesses out there, is the new criteria that came in place as part of the PPP Flexibility Act, and it's the third criteria on the EZ application. And so this one states that if you are unable to operate at the same level of business activity due to regulation or guidance from federal sources, generally the CDC, Health and Human Services, or OSHA, but those could be indirectly applied to your business through either state or local ordinances. So if you were involved in a non-essential business, and construction was in many states deemed non-essential, or some trades were in particular, then you could contest that you don't have to worry about the FTE test if you had restrictions on your ability to work during that period of time. This is a slam dunk for things like restaurants and hospitality, other businesses that were directly impacted by closures and things like that. In the construction space, it can be a little bit more problematic because in some states you were considered essential services. And that can even get down, as I mentioned, to the trade level. So you have to look at your particular situation. But if you met that criteria and you couldn't operate at the same business level, and it didn't have to be for the whole period, it could even be for a portion of the period, then you're exempted from the FTE testing, which is a huge win for a lot of companies. Now, there's also the exemption for if you did have a reduction, again, just like we had in the wage test. If you did have a reduction from February 15th through April 26th, but you restored that, you would not also have to apply the FTE test. But mechanically, I'll go into how the FTE test applies if you don't meet one of these safe harbors. So Rick, if you can go to the next slide for me. So I'm sorry, this was just more documentation on that business activity safe harbor. That's the one for number 3. So the way the FTE reduction quotient is taken into consideration, you look at your FTEs. FTEs are defined now, and we do have guidance on that we'll go through in just a second. But there are certain exemptions that you have that don't reduce your loan forgiveness that you can report on the long form 3508. And so if you tried to rehire employees and were unable to do so, or if employees were fired for cause or voluntarily resigned, all of those are kind of pro forma things that you can take into consideration. So for instance, if your headcount went from 20 people down to 15 people, but 3 or 4 of those folks were because they voluntarily resigned, then you would get to pro forma those back. So your FTE reduction wouldn't be 25% in that example. It might only be 5% if maybe only one of those employees was due to somebody that you laid off. So just the things that you need to consider in the long form if you are doing the FTE calculation. So Rick, if you can go to the next slide for me. So the FTE test itself is fairly simple. Again, you calculate your full-time equivalents during the covered period, and you compare that to a benchmark period. And the benchmark periods are one of 2 pre-COVID periods. So you can either look at basically your prior year covered or prior year similar period, so from February 15th through June 30th, or you could look at the beginning of 2020 and see what was happening then. And you'll want to calculate both of these if you have to do this test and determine which one of these gives you a lower benchmark FTE count, right? Because that's the denominator in your equation, and that'll help you get a lower reduction percentage if you did happen to have a reduction during the covered period. Now, from an FTE perspective, I do want to go through how you calculate FTEs. And Rick, if you could go to the next slide. So there are two ways to do that. So from an FTE perspective, the SBA has come out with clarification and said an FTE is defined as an employee that works 40 hours or more a week. And obviously, that would say that if somebody worked 50 hours, they would count as one FTE. You know, we also believe salaried employees count as one FTE, regardless of whether or not they're on an alternative work arrangement. Where the difference between these two methods come into play has to do with part-time employees, so those folks that work less than 40 hours. The standard method is that you just add up all the time for people that were working less than 40 hours a week and divide it by 40, and that would give you an FTE count. So if you only had one part-time employee and that person worked 30 hours, they would count as a 0.75 FTE for this calculation. Conversely, if they only worked 10 hours, they would count as 0.25 FTEs, right? Now, there is a simplified method that you can use for part-time employees. And so if you choose to use the simplified method for all part-time employees, you basically assign a 0.5 FTE for them. And the important thing to know is you have to apply this method consistently. So we talked in the previous slide about the numerator period being the covered period and the denominator period being one of those two pre-COVID periods. It's important that you make sure that you apply this either standard method or simplified method consistently when determining your FTE counts. And so as long as you do that, you can apply either one of these methods. So, you know, there's really no strategy per se. You can calculate these to see which one gives you a better answer. So for instance, if, you know, most of your employees are working 30 hours a week now as opposed to 40, you might want to use the standard method because that would give you a higher full-time than potentially otherwise, or full-time equivalents than the simplified method. So Jen, did you have a question?
Jack, I know we always get a lot of questions through the live stream about people who were laid off and, you know, or they reduce their hours and the employer says, here's a, you know, I want to offer you to come back to work, and then they can't for one reason or another. They decline the offer. Can you just talk a little bit about how that works if anybody finds themselves in that position, and kind of what the process has to have been, how that impacts their ability to, I guess, file the easy application as opposed to the regular? Because I think there are nuances there.
Yeah. No, that's a great point. So you can consider if you tried to hire somebody back. So let's say you did terminate somebody, and then you went to them and asked them to come back to work for you, and your offer for them to come back to work was same equivalent hours and same wage rate, right? Because it had to be an equivalent pre-COVID offer. If you extended that opportunity to them and the employee, for whatever reason, decided not to come back, there is a safe harbor out there that says you do not need to consider that impact in your FTE calculations, and you don't need to consider that impact on whether or not you meet the safe harbor. So if you did that for all of your employees, and they decided not to come back, even though your headcount might be reduced, you still can meet one of those safe harbors to use the EZ form. Now, the one twist that came up more recently, though, was that the documentation requirements on this got a little more onerous and may preclude some of you from using this safe harbor. And what I mean by that is originally you had to have a documented offer of reemployment to that individual. And you had to have something that indicated that that employee did not accept the offer. That could just be a rejection via email or text, whatever. You had to have that. More recently, though, the SBA also said that the business had to notify your state unemployment insurance agency of the fact that the employee rejected your offer of reemployment. And we know practically that in a lot of cases, because some people were making decisions based on the fact that they might be making more with the state unemployment with the federal stipend, that they chose not to come back. And from an employer perspective, you didn't maybe provide that notification to the state. So you do have to look at your documentation and determine whether or not you meet all of those safe harbor requirements in order to take advantage of that safe harbor that Jen mentioned. But great point, Jen, and thanks for allowing me to clarify that. So next we're going to go into the forgiveness process, and I did mention there are two different forms. There's the long form, the 3508, and then there is an easy form. And the easy form is available if you meet one of three criteria. The first is if you're self-employed and have no employees. But really, the second and the third go into those things that we talked about in the wage reduction and in the FTE reduction. So if you can demonstrate that you didn't have any reductions greater than 25%, and either you had no FTE reductions or you were unable to operate at the same level of business activity, then you can use the EZ form. And so what that means is you wouldn't have had to apply those other tests anyway. You have to retain that documentation for your files, but now merely you're pulling together the eligible costs and comparing that to the loan amount and then the 60% threshold that Rick talked about. And so the easy calculation is a lot easier. And while you have to maintain all the underlying data to support the safe harbors that you're relying on, you don't have to submit that with your application. So it does make your application process a lot easier. Now, I do want to just bring up to everybody that there is a proposal out there that seems to have bipartisan support right now that there would be blanket forgiveness for loans under $150,000. This would come with likely a one-page certification from the borrower that they used or made their best efforts to use the funds in accordance with the terms of the PPP program. However, right now in Congress, there's really a stalemate related to COVID relief. And so while we were hoping that this $150,000 blanket forgiveness would get passed, in a timely fashion, it's looking less and less like that's going to happen now. Possibly we might not get this until after the election. And so if you are in that bucket, you can contact, your lender to see what their policies are with respect to taking applications under $150,000. Because there are a lot of lenders that are still not taking applications for forgiveness under $150,000 because they are hopeful that this blanket forgiveness will eventually pass. So Rick, if you can go to the next page, I just wanted to cover a few items on when to file for forgiveness. And we did get a great question on this earlier today that I'll cover here. I want to start off by saying there really is no right time as to when to file for forgiveness. But as a borrower and a business owner, there are a lot of things that you should consider when you make that determination as to when you want to file. And this assumes that you've got the mechanics all worked out and you've maximized your potential forgiveness that you have out there. So, some things to consider. The guidance is still not complete. Rick mentioned that earlier. However, the fact that guidance is not complete might not always be a bad thing, right? Because when we have gotten guidance of late, some of it's been positive, like the clarifications we recently got about including salaries and wages that were incurred before the covered period. But some of it can be negative, like the related party rent guidance that limits related party rents to only the interest component on the third party debt. And so waiting for guidance to come out could be a dual-edged sword, and so we don't suggest that would be the only thing you would consider. We do know that a lot of borrowers have considerations around distribution. So if you're having a decent year still and you would like to make distributions, or maybe you feel you need to make distributions to cover tax liabilities of your owners, there is a concern that if you're going to make distributions, the SBA could look at that and say that that if you make those, that's an indication that you really didn't need the PPP funds to begin with, right? So, whether or not you're going to make distributions prior to getting forgiveness is something that you definitely need to consider. You may have expected changes in ownership coming up too, with retirements and other things. The timing of when funds were received versus forgiveness and taxability of those funds are going to be considerations that you might need to take into consider if you have these planned changes in ownership. If you do have other pieces of debt out there, loan covenant compliance could be a factor that you want to think of, and workforce management in general, right? A lot of our clients now are exhausting PPP proceeds sometime after, let's say, 12 to 14 weeks. And at that point, they want to right size their staff now because they no longer have this, government benefit available to help them cover the costs of employees that they are paying that they probably would not otherwise have carried. And so the question then is, well, if you measure costs during, let's say, a 13-week period, and that's what you're going to report on your forgiveness application, but then you decide you're going to wait for another few months to file for forgiveness, but during that period of time, you want to implement a workforce reduction to right size your staff. There is a concern that if you haven't filed that application yet, potentially the SBA could say, we want you to look at your FTE reduction over a longer period of time. And again, so that could potentially impact timing. So Rick, if you can go to the next slide, the question we got in had to do with mergers and acquisitions. And I will say that this is a very complicated topic when PPP is outstanding. There's a decision you'll have to make as to whether or not it's easier just to pay the loan off and get it off the books and not, pursue forgiveness. Now, obviously, as the seller in that case, that's not something you want to hear, but you will need to get bank and SBA approval while that loan is outstanding. And most of the loan agreements that we've seen do call out that if there's a change in control or a significant change in the assets of the company, that it requires approval or you'll be in default under that loan agreement. And so we encourage all of our borrowers that are considering a sale transaction to work with their bank early on in the process, and just know that this is a very complicated topic. So engage with your attorney very early on. It could even affect things like your eligibility to apply for the loan in the first place, particularly if you had a LOI in place and there was a pretty clear intention to sell at the date you originated your loan application. So a lot to think through there. The last thing, Rick, if you can go to the next slide, that I'll cover is a tax planning opportunity. As many of you have heard, the IRS came back and said that if you did get forgiveness for the PPP loan, then the expenses that you paid are not going to be non-deductible. And so a timing issue could come up, is that if you pay those expenses in 2020, obviously, but don't get forgiveness until 2021, you would get to deduct those expenses on your 2020 tax return. So you would lower your tax liability in that year. But when you did get forgiveness in 2021, you would have to effectively disallow those deductions in 2021, and you would increase your tax liability at that time. The benefit potentially to doing that is you're getting the time value of that money. So if, for instance, you had, $100,000 loan, by deferring that tax, assuming you're going to get, full forgiveness, you would save, on average, $40,000 or $45,000 of tax liability on a federal and state basis for the owners that you could leave in the business from a working capital perspective. So we do encourage you to think through the tax planning aspects in terms of when you're going to file, because they do have potential implications. So Jen, with that, I'll turn it back over to you so you can wrap us up.
Oh, well, thank you so much, Jack and Rick, for just the incredibly detailed and helpful guidance. I think that people really are still struggling with an understanding of, what are the things that go into this calculation? How does it work? And when should we do it? So really appreciate that overview. To everyone in the audience, thank you for your questions. Please, we'd love to encourage you to reach out to any of us on the call, whether it's Tim, myself, Jack, or Rick, for any additional consultation that we can provide. Jack, you made a comment yesterday in a session that we were in about just because you can apply for forgiveness, should you apply for forgiveness? And I almost think it would be worth a few seconds to hear from you on that, and then we can wrap everything up and let everybody go for the day. But
I'd be
I
happy
really
to be
that.
happy to comment on that. Yeah, there was a lot of questions and concerns about, whether or not on the front end people were eligible, businesses were eligible to apply for the loan. I think my personal view and the view that CLA generally has been taking is that all businesses, because there was such significant uncertainty as to what the future would hold at that time, were likely eligible to apply for the loan, right? Now, the second question comes, do we ask for forgiveness? And we've got a number of businesses that were significantly impacted by COVID, and they've shut down. They've seen significant decreases in revenues. Clearly, this was a lifeline to those businesses. However, we also have a number of companies that, while they were concerned about the impact of COVID on their business, ultimately they didn't see the disruptions that they were fearful of, and so business kind of continued on as normal, and revenues stayed fairly flat, and they were able to keep working and getting paid by their customers. And conversely, we've even seen some of our clients that were in the right niches or reinvented themselves real quickly that actually saw increases in revenue during this period of time. The question for those businesses that maintain themselves or that increase their revenues is going to be, should I ask for forgiveness? Because formulaically, you will likely be able to ask for 100% forgiveness. You think about the factors that are there. Did you incur the costs? Of course you did. Did you decrease wages? Probably not if your folks were busy. And did you decrease FTEs? Well, no. If you were still cranking out work, you likely would not have had a wage reduction related to FTEs. So formulaically, you'll be able to ask for forgiveness. Now, the question really gets down to, should you ask for forgiveness? Because one of the representations you'll have to make is that the amounts that you're requesting forgiveness for were necessary to keep your folks, your payroll, your people employed. And we don't know how the SBA is going to interpret that. They could interpret it to mean, well, if you didn't have a significant decrease in revenue and your customers were still paying the bill for your employees, then you really didn't need these funds, and therefore the SBA could challenge if you ask for forgiveness. Now, we don't know if that's the way they're going to interpret that, but it is definitely in the realm of possibility. And there was, Secretary Mnuchin did address this at one point in time in a comment to the Senate Small Business and Entrepreneur Committee. And he said that, they considered putting in a revenue decrease test for forgiveness. Ultimately, they didn't do that because they didn't want to change the rules on everybody, but that the SBA and Treasury was hoping that borrowers would do the right thing, and that if they didn't ultimately need the funds to prop up their business, that they wouldn't ask for forgiveness and just treat these things as short-term, low interest working capital loans, and then repay them when the time comes. So, there is no right answer on that. Each company's personal circumstances will need to be considered, but we are trying to engage our clients in that discussion around that decision there. The only other thing I'll add is that just like on the front end, when all the loan data got released on who received the loans, it is very likely that the data on who requests and receives forgiveness will also be released. And so when you're making that decision, take that public perception risk into consideration as well, particularly if you're one of those businesses that saw an uptick in business and the community understood that. You might run some risk of negative public perception if you do request forgiveness in that environment. So that's all I've got, Jen.
Well, thank you so much. I think that was an important point. I'm glad we took the time to make it. I like the way you cover that. So I want to thank you guys again. Jack and Rick, you did an amazing job. Tim, thanks for the introduction. And then Danny, our friends at Midwest Bank, and those of you at the Plumbing Industry Council who pulled this together. We're really grateful for the opportunity to knowledge share with you, to engage with you as a community partner, and just continue these relationships. So please do feel free to reach out to us at any time. And Nicole and Danny, if there's anything else that we can do, please let us know. But at that, I'll hand it over to you to wrap it up.
Jen, thank you. And thank you to everybody. Once again, great partners. We appreciate the expertise that you bring to this subject. I'd just like to point out to everybody on the call, we thank you for being on the call. If you have any questions, please feel free to reach out to CLA or the bank. The customers of Midwest Bank Center, we thank you. If you're not, we'd love to talk to you if you have any banking needs. So we appreciate you being on today. We hope you found it informative. And I wanted to close by having Ray Hefner, who, as I said earlier, prompted me to do this, and I think it's good for everybody. If he has a few closing words. Are you out there, Ray?
Yeah, Dan, I'm out there. Can you guys hear me? All right, great. Hey, on behalf of the Plumbing Industry Council and the Council of Construction Employers, I want to thank CLA and Midwest Bank Center for putting on this program. I think it's important. I think it's timely. I hope everybody got something out of it. And we look forward to doing these types of things back in the future. So everybody on the CCE side, thanks for attending. On the Plumbing Industry Council side as well. And to CLA and Midwest Bank Center, appreciate this program very much.
Thanks, Ray.
Dan.
And thank
you, Ray.
Thanks, everybody, and have a great day.